Preparing for a financial analyst at EDEKA interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a financial analyst at EDEKA? I am attracted to EDEKA because finance directly influences everyday retail decisions, from pricing and assortment to store investment and supply chain efficiency. The cooperative structure also makes the role commercially interesting, since analysis must support both central functions and independent retailers. I would bring strong Excel skills, financial discipline, and curiosity about operational drivers. My goal would be to translate data into practical recommendations that improve margins, cash generation, and sustainable growth. While answering, connect your analytical skills to grocery retail, EDEKA's cooperative structure, customer focus, decentralized operations, and the opportunity to support profitable growth through better planning and commercial decisions. Question 2. What do you understand about EDEKA's business model? EDEKA operates as a cooperative network combining independent merchants with central and regional organizations. The group supports purchasing, logistics, private label development, technology, marketing, and other services, while merchants run stores with local accountability. That model creates purchasing power and a strong local customer connection, but it also requires careful performance analysis across regions, formats, and ownership structures. A financial analyst must distinguish centrally controlled effects from merchant-level operating decisions. Make sure to cover EDEKA's cooperative organization, independent merchants, central wholesale and service activities, retail stores, purchasing scale, and why the structure creates both synergies and analytical complexity. Question 3. How would you build a sales and gross margin forecast for a supermarket business? I would begin with a driver-based model by store format and region. Sales would reflect traffic, basket size, price inflation, promotional intensity, store openings, closures, and like-for-like trends. Gross margin would then incorporate category mix, supplier cost changes, discounts, private label penetration, and shrinkage. I would compare the forecast with historical seasonality and actual trading data, test sensitivities, and reconcile the output to management's assumptions before presenting key risks and actions. In your answer, talk about store-level sales drivers, volume, price, like-for-like growth, promotions, category mix, shrinkage, supplier costs, seasonality, and reconciliation to historical results and management assumptions. Question 4. Which KPIs would you monitor to assess supermarket performance? I would monitor like-for-like sales, customer traffic, average basket value, gross margin percentage, and promotional effectiveness. Operating KPIs would include labor cost per sales euro, sales per square meter, shrinkage, waste, stock availability, inventory turns, and store-level EBITDA. I would also track cash conversion and capital expenditure. The key is not viewing metrics independently. Strong sales growth with falling margin or rising stock losses may indicate unhealthy promotional or operational choices. Be sure to mention revenue growth, like-for-like sales, traffic, basket size, gross margin, EBITDA, labor productivity, shrinkage, inventory turns, cash conversion, and comparisons by store format and region. Question 5. Explain the difference between a budget, forecast, and actual result. A budget is the approved financial plan, normally prepared before the year begins and used to set targets. A forecast is the latest estimate of expected performance, updated as trading conditions change. Actuals are the results recorded in the accounting system. I would compare actuals with both budget and forecast, isolate operational and timing variances, and update the forecast when evidence changes. That separates accountability for the original plan from realistic forward-looking decision-making. While answering, distinguish the original target, the latest estimate, and reported performance. Explain timing, variance analysis, accountability, reforecasting, and how each supports different management decisions. Question 6. How would you investigate a significant unfavorable gross margin variance? I would first confirm that the variance is real by checking postings, period cutoffs, and the gross margin calculation. Then I would decompose it into selling price, purchase cost, volume, mix, promotion, rebate, shrinkage, and waste effects. I would compare regions and categories to locate concentration, speak with commercial and operations teams, and distinguish temporary timing from structural pressure. Finally, I would quantify corrective actions, assign owners, and track whether margin recovers in subsequent periods. Make sure to cover data validation, price and cost effects, product mix, promotions, shrinkage, supplier rebates, timing, regional concentration, root cause ownership, and corrective actions. Question 7. How do the three financial statements connect? The income statement measures profit, which increases retained earnings within equity. The balance sheet shows the resulting assets, liabilities, and equity at a point in time. The cash flow statement reconciles profit to cash by adjusting for non-cash items such as depreciation and movements in receivables, payables, and inventory, then adds investing and financing activity. I always check that ending cash agrees across statements and that balance sheet movements explain the cash flow bridge. In your answer, explain how the income statement flows into equity, balance sheet changes affect cash flow, depreciation and working capital bridge profit to cash, and why consistency checks matter. Question 8. What working capital drivers are particularly important in grocery retail? Inventory and supplier terms are the central drivers. Supermarkets need sufficient stock availability, but excess inventory creates markdowns, waste, and cash consumption, especially for perishables. Longer supplier payment terms can support cash flow, while promotions and seasonal peaks change purchasing patterns. I would monitor inventory days, stock turns, aged stock, shrinkage, payable days, and service levels together. Improving working capital should never damage availability or customer experience, because lost sales can outweigh the cash benefit. Focus on inventory, supplier payment terms, accounts payable, perishables, stock availability, promotions, seasonality, shrinkage, and the balance between cash release and customer service. Question 9. How would you evaluate a proposed investment in a new store or store refurbishment? I would build an incremental cash flow model covering sales ramp-up, gross margin, labor and occupancy costs, maintenance, initial capex, working capital, taxes, and terminal value where appropriate. I would assess cannibalization of nearby stores and include downside cases for slower traffic or higher construction costs. The decision should consider NPV, IRR, payback, and strategic factors such as market access. I would clearly separate assumptions supported by evidence from management judgment. Be sure to mention incremental sales, margin, operating costs, capital expenditure, working capital, cannibalization, ramp-up, NPV, IRR, payback, scenarios, and strategic benefits. Question 10. What is a DCF, and when would you use it in retail analysis? A discounted cash flow values an asset or business by forecasting future free cash flows and discounting them to present value using an appropriate cost of capital. For a retail project, I would model operating profit, taxes, investment, and working capital needs, then calculate terminal value carefully. DCF is useful for long-term investments, although results are sensitive to margins, growth, WACC, and terminal assumptions. I would therefore support it with scenarios and market-based valuation checks. In your answer, define discounted cash flow, explain free cash flow and WACC, distinguish enterprise and equity value, and discuss sensitivity to growth, margins, investment, and discount rate assumptions. Question 11. How would you assess the profitability of a promotional campaign? I would compare promotional sales with a credible baseline, not simply measure total units sold. The analysis would include the selling price reduction, product margin, supplier funding, incremental traffic, basket effects, cannibalization of other products, and additional waste or labor. I would calculate incremental contribution profit and evaluate whether new customers return later. A promotion can raise revenue while destroying value, so I would recommend it only when incremental contribution and strategic benefits justify the cost. Make sure to cover incremental volume, baseline sales, price discount, gross margin impact, supplier funding, cannibalization, waste, customer behavior, and post-campaign measurement. Question 12. How would inflation affect EDEKA's financial performance and forecast? Inflation can raise procurement, wages, energy, logistics, and construction costs. Passing increases to customers may protect nominal sales and margin, but volume can fall, shoppers may trade down, and competitors may respond differently. I would model price, volume, mix, and cost effects separately, including timing differences between supplier increases and retail price changes. I would also stress test wage and energy assumptions, then monitor real sales, customer behavior, and margin by category. Discuss supplier costs, retail prices, volume elasticity, mix, wages, energy, logistics, margin timing, working capital, customer trade down, and scenario analysis for different inflation outcomes. Question 13. What is the difference between EBITDA, EBIT, and free cash flow? EBITDA is earnings before interest, taxes, depreciation, and amortization, so it highlights operating performance before non-cash asset charges. EBIT deducts depreciation and amortization and better reflects the cost of using stores, equipment, and technology. Free cash flow starts from operating performance and deducts taxes, capital expenditure, and working capital investment, among other items. EBITDA is useful for comparison, but free cash flow is critical when evaluating investment capacity and financial sustainability. While answering, define each measure, explain depreciation and amortization, capital expenditure, working capital, taxes, and why profitability does not automatically equal cash generation. Question 14. How would you ensure accuracy in a large Excel reporting model? I would separate raw data, assumptions, calculations, outputs, and checks into clearly labeled sections. Inputs would be controlled and ideally linked to approved source files rather than hard-coded repeatedly. I would build balance checks, period-over-period reasonableness tests, subtotal reconciliations, and exception flags. Before distribution, I would review formulas independently, test unusual movements, protect key cells, and document assumptions and version history. Reliable reporting depends as much on process control as spreadsheet skill. Be sure to mention structured inputs, clear formulas, checks, reconciliations, version control, controlled assumptions, independent review, documentation, and avoiding hard-coded figures in calculation areas. Question 15. Tell me about a time you used data to influence a business decision. In a university consulting project, a retailer wanted to understand falling category profitability. I cleaned transaction data, separated traffic from basket effects, and found that a heavily promoted product attracted customers but displaced higher margin items. I presented a scenario analysis showing that reducing its promotional frequency could improve contribution while preserving most traffic. The team adopted the recommendation for a pilot, and I learned to pair rigorous analysis with a practical implementation plan. In your answer, use a concise star structure, explain the business problem, describe your analysis, quantify the recommendation, and show how stakeholders acted on the result. Question 16. How would you present disappointing financial results to a non-finance manager? I would lead with the headline, "What missed plan, by how much, and why it matters." Then I would use a simple bridge separating external factors, operational drivers, timing, and controllable actions. I would avoid accounting jargon and explain implications in commercial terms, such as lost margin or delayed cash generation. I would acknowledge uncertainty, invite the manager's operational perspective, and finish with specific actions, owners, and a timetable for monitoring recovery. Focus on clarity, facts, root causes, business implications, visual simplicity, ownership, actions, and avoiding technical jargon or blame while preserving accuracy and transparency. Question 17. How would you analyze a store that has strong sales but weak profitability? I would decompose the store's economics from sales to contribution profit. Strong revenue may conceal low-margin categories, excessive discounting, high labor intensity, waste, shrinkage, energy costs, or unfavorable rent and logistics. I would compare the store with similar formats and examine sales per square meter, margin by category, labor productivity, inventory turns, and promotion returns. The solution might involve assortment, staffing, pricing, or process changes rather than simply pursuing additional sales. Make sure to examine gross margin, category mix, promotions, labor, rent, energy, shrinkage, waste, logistics, inventory productivity, and whether sales growth is genuinely incremental. Question 18. What accounting considerations would you review under International Financial Reporting Standards 16 for store leases? Under International Financial Reporting Standards 16, most store leases create a right-of-use asset and corresponding lease liability at commencement. The asset is generally depreciated, while the liability generates interest expense as it unwinds. I would review lease terms, renewal options, discount rates, modifications, and variable payments carefully. The standard typically increases EBITDA compared with old straight-line rent treatment, so I would avoid misleading comparisons and assess cash payments separately when evaluating store economics. Discuss right-of-use assets, lease liabilities, discount rates, depreciation, interest expense, renewals, modifications, variable payments, and the effect on EBITDA and cash flow presentation. Question 19. How would you forecast cash flow during a period of rapid store expansion? I would create a monthly cash flow model linking the store opening timetable to construction payments, equipment purchases, initial inventory, hiring, marketing, and ramp-up trading. I would incorporate supplier terms, expected customer receipts, pre-opening costs, and temporary operating losses. Timing is crucial because cash may leave months before revenue begins. I would run delayed opening, cost overrun, and slower sales scenarios, then identify minimum liquidity and any required funding actions. In your answer, include opening schedules, construction capex, inventory build, supplier terms, ramp-up losses, working capital, funding needs, timing risks, and downside liquidity scenarios. Question 20. What would you do in your first 90 days as an EDEKA Financial Analyst? In the first month, I would learn EDEKA's structure, reporting calendar, KPI definitions, systems, and key stakeholders across finance and operations. In the second, I would reproduce core reports, validate data flows, and understand recurring variances and planning assumptions. By the third, I would identify a practical improvement, such as automating a reconciliation or strengthening a driver-based forecast. I would focus first on accuracy and relationships, then recommend changes supported by evidence. Be sure to mention learning the business model, understanding reporting definitions, meeting stakeholders, validating data sources, reviewing recurring processes, identifying quick wins, and building credibility before changing systems. If you are still with us, congratulations! You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.